take a deeper dive into the markets and what is behind stock moves today. We do want to bring in Gene Goldman, Chief Investment Officer at Cetera Financial Group. Gene, great to have you on the show here, and a classic case as good news is bad news for stocks, but on net, is this jobs report good over time for the markets?
Well, first of all, good morning, Chris, and good morning, Dave. Thanks for having me on this Triple Witching Day. Triple Witching Day in terms of payroll, Roaring Kitty, and National Donut Day. So thank you so much. So payroll report. If I look at the payroll report, three things I took away from it right away. First of all, I think the payroll report, number one, went all the wrong ways for the Fed. It closes a rate cut in terms of July and maybe September, but we'll see. The second is that within the report, we had the usual surge in the usual suspects. We saw government jobs up 43,000, healthcare up 83,000. If you look at the past 12 months, 50% of the job gains in the payroll report came from these two areas. Third thing, which I think is the most important, is that this report doesn't really jibe with all the jobs data we've seen this week. I think the issue is that the payroll report is very backward looking. It was very strong, but all the forward looking labor indicators, PMI, JOLTS, Indeed, jobless claims are all showing a weaker environment. So take this together, we think that this report was a little strange report, but again, it doesn't jibe with all the jobs data and the economic data that we've seen lately.
You know, that's what I just mentioned. Everything I'm reading this morning online, all the traffic seems to suggest they're not buying that jobs number. Why are you not? And how important is the wage growth now, 4.1%, if you're Jerome Powell?
Yeah, I think, and obviously, I think the wage growth is so very important because clearly wage growth that ties into inflation. I just don't buy the number either. I think that if you look at the fact that the unemployment rate did pick up to 4%, we haven't seen that since, as you said, January of 2022. But I think more importantly, wages did rise a bit, but they're going to slow down. You know, if you look at quit rates are declining pretty quickly. If you look at job openings are declining. Take all this together, while wage growth did pick up a little bit, we do expect it to slow down throughout the rest of this year.
It's interesting, Gene. We see the Fed funds future rate moving in reaction to this jobs report. I gave it a little bit of a look before 9 a.m., just checked it as we come on the air 10 minutes into the start of trade. And the majority of traders do still expect one rate cut in September and then another rate cut in December. But it is pretty close to the margin. Given what you're noting about differing data out there, do you think that this report changes the game for the Fed and its path on rates?
I think, and that's a great question. I think next week we'll get so much more information. You know, obviously, we have the Fed meeting on Tuesday and then Wednesday. I think the Fed meeting will be so very important because, first of all, there's zero prospect that they cut rates next week. The markets are going to really focus on what the Fed says in the dot plot. And there's three things we can look for in the dot plot. Number one is that year-end inflation estimates should be raised a little bit from the previous 2.6%. Inflation was so much higher than expected earlier in the year. Second of all, year-end economic growth is likely going to be lowered a bit. As I mentioned before, the consumer personal spending consumption has started to come down a bit. This will need to be factored in the dot plot. And a third point, really, Chris, into your question, you know, it's no longer going to show three rate cuts, probably one or probably two. I think it's going to lean to two because the Fed members continue to keep suggesting they want more time. But here's my big takeaway. With inflation rolling over, if you look at core PCE less rent, it's at 2.2%. And that's pretty close to the Fed's target. And the Fed can't keep ignoring the impact of high rates in the economy. Here's what my key point. Like a good company management, I can see the Fed sandbagging rate expectations, maybe saying one or two, and then beating them with two or more rate cuts through this year.
Interesting.
So you think Powell can get that number to 2%?
I think he's very close to 2%. I mean, again, just taking core PCE, subtract out rent, we're at 2.2% year over year. Then you see the slowdown in the employment picture. You see the.
Why are you subtracting rent? Because you think it's a lagging number?
I think if you look at, say, for example, CPI rent is up 5.8% year over year. It's a very lagging number. But what we look more carefully at is asking rent. This is new apartments being listed by landlords on apartments.com, for example. This is down 1.1% year over year. And this will continue to flow forward. This flows into rent, which will flow into core PCE. And the other important point, why we've seen elevated core PCE is that services inflation has been pretty high. But remember, the services economy has weakened nearly every month since November of 2021. This will continue to flow forward, so we are pretty confident that core PCE gets very close to the Fed's target by year end.
Gene, you are Chief Investment Officer, so I want to ask what you're advising clients in terms of a breakdown within their portfolio, knowing that rates are still elevated, but the stock market has had a strong year.
Yeah, that's a great question. So we still think we'll have a great year for the stock market. We're still optimistic about the stock market, but near term, we do expect a pullback. We do expect some type of maybe a correction, a short-lived correction like we saw in October of last year. You know, if you think about the stock market, the S&P, it's up 28% since the October 27th correction low, but there's a lot of headwinds facing the stock market. Uncertainty about Fed action, as we talked about. Pressures are rising on the consumer. And third of all, here's the big point. Valuations are pretty high. If you look at the PE ratio on forward earnings, it's around 21 times forward earnings. The average for the last 25 years is 16.5. But then if you factor in the gains that we've seen in the earnings on the Mag 7, primarily driving the S&P 500. But the Mag 7 has growing earnings, has been growing returns dramatically higher than the rest of the S&P 500. But if you look at forward earnings estimates, that gap is expected to widen dramatically. So you have high expectations, increased valuations. This could really harm stocks in the near term. But again, very short-lived because there's a ton of cash on the sideline ready to get in, like October of last year.
Gene, I know you don't talk individual stocks in your role. Say a family member calls you, though, at about 11 o'clock and says, Gene, okay, Roaring Kitty's about to go live on YouTube. I want to go all in on GameStop. You tell them what?
And you've been talking to my mother. My mother does the same thing. So I think we would say, you know, listen, when you look at a stock, an individual company, you've got to look at three factors. Number one, technicals. Number two, valuations. And number three, fundamentals. So technicals, we'll see what Roaring Kitty says. But valuations, I mean, come on. You know, if you look at the company, it's pretty overvalued. But I think more importantly, the fundamentals. I mean, you have a paradigm shift going on in our software and our video game industry where everyone is downloading video games from the internet. I'm not going to go to a store and buy my cartridge for my for my PS. I'm not sure what video games are. I'm still an Atari guy. So for my Atari system, and I'm not going to go and buy a video game for my Atari at a store. I'm going to download it. So I'm a little concerned about what could happen at 9 o'clock Pacific, 12 o'clock Eastern time.
Interesting. Shares
Atari reference.
paring their losses, Gene, on GameStop. That's down 5%. Maybe GameStop is the place for you then if you're still doing Atari.
No way you know what an Atari is.
Yes, of course. We interviewed the founder of Atari here. I give you credit, Gene. That's Gene Goldman, Chief Investment Officer at Cetera Financial Group.